The Federal Reserve made a move that means you will pay more on any kind of debt that you have.
Yeah, the Fed raised the interest rate by another 3/4 of a point. And while that may sound minimal, it translates to something major. So what does this mean for you? Well, take this for example. For every $10,000 you're in debt, a 0.75% hike means that you'll pay an extra $75 in interest. That's on top of what you were already paying.
And interest rates impact your everyday life. If you have a credit card, trying to get a home loan, or any kind of loan at all, you are going to feel this.
Team coverage breaking down how this hike can impact you and your family.
We begin first with WRTV's Nikki DeMentri zeroing in on credit card debt tonight.
Nikki, what can we expect when we're making payments?
All right, so get this, guys. In 2022 so far, Americans have racked up $887 billion, that's with a B,
wow.
$billion in credit card debt. That's a lot of money. Now, this is all according to online lender LendingTree. Now, one financial expert I spoke with tells me about half of Americans in debt pay month to month. So with another interest rate hike, those in debt or hovering close to it from credit cards could be in trouble.
At lunchtime on Monument Circle, it's hard to find many Hoosiers not using credit cards on a regular basis.
Use them a lot?
Yes, points and to build credit.
Yeah, points. I have one credit card. I had to stop using it because I was just like going crazy on it.
I pay it off every month, but I just use it for everyday expenses.
I just recently got mine. I typically use it to pay for gas and stuff.
But when interest rates increase, historically, so do credit card rates, meaning it's more expensive to use them, and it'll cost you more to pay back any balances.
Trying to discourage me to use it, but it's being like set 2 alarms on my phone to pay that off at the month time.
According to online lender site LendingTree, the average minimum credit card interest rate right now is hovering around 18%.
And that is at a historic high as well. So a lot of consumers, basically half of those, I should say, that carry credit card debt are month to month.
Letterman's best advice for everyone in debt or not is to budget. For instance, consumers should look at subscription services and see if several could be cut.
Look to find ways that you can actually save and apply more money towards that debt. So eventually you'll get out of debt faster.
For those in credit card debt, economists and financial experts urge you to pay it off as soon as possible.
That's what, by the way, the Federal Reserve is hoping you'll do, is instead of going out and buying something new, going on a trip, using your credit card, that you'll pay off that debt. That will slow the economy, we hope, just a little bit.
Now, other tips to avoid worsening that credit card debt includes paying down the balance and looking to use zero balance transfer cards. Nicole.
And Nikki, we know the Fed is hiking interest rates in an effort to stop any sort of recession, but will that happen?
Yeah, right. That's the big question.
Yeah.
Now, the economist I spoke with, Dr. Michael Hicks, who you heard from in that piece, I should say, said there's a 50-50 shot.
Okay.
So if inflation continues rising, even after that inflation, or I shouldn't say inflation, it continues to rise as we're seeing interest rates. Sometimes you can't talk.
It's a hard story.
It is, but when interest rates hike, if that inflation continues, that means we're going to see a recession next year.
Okay.
Simply
Nikki,
put.
thank you so much.
Thank you.